In this special session of IFRS 17 for complete beginners, we're going to discuss IFRS 17 for complete beginners, which means we're going to assume no prior understanding of IFRS 4 or IFRS 17. The purpose here is to really explain IFRS 17's framework at a conceptual level, to explain why we needed a separate standard for insurance contracts in the first place and how IFRS 17 tries to capture insurance contracts. I am myself Imaduddin, the founder of IFRSmasterclass.com and IFRS trainer, and right now I'm converting my corporate training programs into online courses so everybody like you can reach and access my courses at their convenience, at their pace. So if you want to learn more about IFRS 17 at the deeper level, at a professional level, you can just access my course on IFRSmasterclass.com. Alright, so let's get into the basics. Why we needed IFRS 17 in the first place. But before we understand the need for IFRS 17, maybe we should just shed some light on insurance contracts. So what exactly is an insurance contract? So IFRS 17 defines an insurance contract as a contract under which one party, the issuer, accepts significant insurance risk from another party by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholder. Now this definition is very important because this is the primary condition for the applicability of IFRS 17. Let me give an example. So for example, when we hedge our financial risks, for example, interest rate risk, we are still transferring risks, right? But that is not an insurance contract. That is a derivative under IFRS 9. So how do we make this distinction? To make this distinction, we need to first understand what insurance risk is. Let's try to dive a little deeper into what this really means. So let me give an example. For example, a contract requires the issuer to pay a specified sum to the policyholder if there's an earthquake in an Apple Island. So the policyholder has as a contract from the issuer that policyholder will receive an amount from the issuer if there is an earthquake in the Apple Island. So would this contract amount to be an insurance contract? Would this be within the scope of IFRS 17? Well, according to the definition we just read, actually that's not the case. Let's change the situation a little bit to better understand what we're trying to say here. So there's another contract, and this contract requires the issuer to compensate the policyholder in case an earthquake in Banana Island damages the policyholder's factory. Right now, we're not talking about just a random earthquake at a random island. We are talking about the damage to the policyholder's factory due to that earthquake. In this contract, is this contract within the scope of IFRS 17? Well, at least it meets the definition of an insurance contract. Why exactly? The risk is being transferred from the policyholder to the issuer. Any random uncertain event cannot be classified as an insurance risk unless that is a damage to the policyholder. So what condition do we have here? Number one, to be an insurance risk, some other party must undertake it. And second, the risk should be specific to the policyholder. Very simple. Now let's slightly broaden our perspective of what an insurance risk is and how it is different from financial risk. So when we talk about insurance risks, we're talking about risks such as death or survival of the policyholder, injury, illness, disability, loss of property due to damage or theft, failure of a debtor to make payment when it is due, a possible change in a non-financial variable that is specific to a party to the contract. When we talk about financial risk, we're talking about the risk of possible future change in one or more of the following. What? Interest rates, financial instrument prices, commodity prices, currency exchange rates, indices of prices or rates, credit ratings or credit indices, any other variable except for a non-financial variable that is specific to a party to the contract. So when we're talking about financial risk, we are talking about variables that change and that may, although cause a risk to the policyholder, but even or the contract holder, but they do not amount to insurance risks. So any contract that covers those risks, specifically that contract or that part of the contract does not amount to being an insurance risk and cannot be defined under IFRS 17 as an insurance contract, or that part of the contract cannot be defined as an insurance contract. So why is it that insurance contracts are so different in accounting? Why should we have a different accounting system? So when we talk about insurance contract in isolation, For example, we can say that a particular person, if he dies in the next 3 years, he might get a certain amount. Let's say his premium is $1,000, and if he dies, he gets $100,000 within the 3 years. So this 3 years period, the term of that contract, in which if he dies, he will receive the money. However, his death in those 3 years is a contingent event, which means it might occur or it might not occur. If it occurs, the insurance company will have to pay the amount. If it doesn't occur, if the person doesn't die, the insurance company will not have to pay any amount at all. Doesn't this very fact make this a contingent payment? And if you remember from IAS 37, contingent payments don't even need to be recognized in the final statements. We only need to disclose contingent events, right, and contingent liabilities. However, because the nature of an insurance business is such that the company would probably be issuing such insurance contracts to hundreds or thousands of such people, and therefore it would be absolutely improbable for the company to not have to pay anything to anyone, which means the nature of this business and the nature of this contract makes this whole thing very probabilistic, and therefore the accounting should also be based on probability of what the outflow would be. And in reality, if there are a lot of contracts and the estimates are right, the probability might approximate the actual events, or the actual claim payments might actually approximate the probably expected cash outflows. Anyways, what I'm trying to say here is really that the cash outflows and inflows would have to be predicted or estimated, and based on that estimate, we can value a particular group of insurance contracts. We'll dive deeper into this when talking about accounting under IFRS 17 for insurance contracts, but here's the simple concept behind this whole thing. Before going any further, let's just talk about what kind of insurance contracts are there in reality. So insurance can be divided into two broad categories: life and health, and property and casualty, or you can simply say life insurance or non-life insurance. A life insurance is simply a contract that guarantees the insurer pays sum of money to one or more named beneficiaries when the insured person dies, in exchange for premiums paid by the policyholder during their lifetime. Right? So life insurance is a very common kind of insurance. So people do life insurance to protect their families against the uncertain event of their own death. So in market, there are a lot of kind of insurance policies, and because the nature of life insurance is long term, people tend to have some investment plans embedded into their life insurance policies. So we can have term life insurance plans, which are pure life insurance. So just like the example we gave, if a person dies in a particular period of time, for example in 3 years, his family would get a certain amount. But then there could be more investment based plans where certain amount of premium is invested into, it goes into life insurance coverage, and some amount goes into an investment which will have to be paid if the person dies, or sometimes in case where he doesn't even die, where he can simply withdraw those amounts. So there are unit linked products, there are endowment insurance plans, there are whole life insurance, and there is universal life insurance. The other kind of insurance is non-life insurance, which is usually called a general insurance, and includes the protection against damage to automobile or homeowners. General insurance is typically defined as any insurance that is not determined to be life insurance. So there's a range of possible arrangements which could result in non-life insurance or general insurance. So when we talk about non-life insurance, we can have fire insurance, marine insurance, motor, health, home, factory, travel liability. Alright, so IFRS 17 has specific models, specific frameworks for accounting for insurance contracts. There's a simplified framework which is called the premium allocation approach, which is normally used for general insurance contracts, because general insurance contracts tend to be less than 1 year. And the main model under IFRS 17 is a general measurement model. And the great thing about general measurement model is that it makes companies comparable. It provides a consistent framework for accounting for all companies. So to understand why we need IFRS 17, first understand what we are trying to do here. We're trying to value insurance contracts in a way that we can compare the performance of one company with another because when we have a lot of insurance contracts in our books, we have to properly represent what those contracts mean in financial terms, what cash flows would result because of those contracts, which cash flows or which changes in cash flows or which changes in insurance liabilities relate to current period, which relate to future period. All of these determinations should be made at a constant level to be comparable, not just with companies within the insurance industry, but should somehow conceptually be relevant to comparison with other industries as well. So we should not just be presenting revenue on cash received basis, we should be presenting revenue on earned basis, like IFRS 15. So as services provided, we earn that amount of money, and so therefore the matching concept should also be held. So before IFRS 17, there were a lot of inconsistencies in the accounting practices. Here are some of these which are actually suggested by IASB itself. So I'm just sharing with you their view of why we needed IFRS 17, what kind of inconsistencies were there around the globe in insurance companies, and sometimes some very large insurance companies as well, because there was not enough guidance in IFRS 4 for all of these requirements. IFRS 4 was basically a stopgap standard, which means IFRS 4 really wanted to make sure that there is no under-reserving. There are not very bad practices, but a lot of wrong practices or a lot of not ideal practices were still allowed or possible within the framework of IFRS 4. So IFRS 17 provides a consistent framework that provides a proper solution or proper model to account for insurance contract, the changes in insurance liabilities, and everything in between. So here are some examples. Some companies recognize as revenue all the premiums received. Others exclude from the reported revenue any savings received through premiums. So this is an inconsistency. Sometimes companies recognize or represent as revenue all the premiums received. Similarly, some companies capitalize and amortize over years the cost incurred in issuing new insurance contracts. Others expense these costs when incurred. So under IFRS 17, these are called insurance acquisition cash flows. So there's a specific way we have to account for this, and we cannot change that way based on our will. But before IFRS 17, people could either expense these out or could possibly capitalize it and amortize it over the period. And that amortization pattern was not even consistent among companies. Similarly, some companies use updated discount rates to measure the insurance contracts. Others use historical discount rates. IFRS 17 provides a proper framework. So, for example, CSM would always be valued at locked-in discount rate, but the fulfillment cash flows would be valued at an updated or current discount rate. Don't worry if you not immediately understand all of these things, because these have to do exactly with the insurance accounting. Right now, we're just going to tell you that there are reasons why we have IFRS 17 and why we cannot just continue with other standards or ad hoc practices, why it's not feasible to continue with ad hoc practices in IFRS 4 forever. Alright, let's now understand the scope of IFRS 17. So IFRS 17 is applicable both on insurance contracts as well as reinsurance contract. So reinsurance contract is when insurance companies get their risk insured by reinsurance companies, which means this is called the insurance risk is being ceded. For example, if an insurance company has insured the risk of 100 factories that may be burned through fire or damaged otherwise, the insurance company itself might hedge it or transfer its risk of having to pay claim to those companies to the insurance company. And so when, for example, 2 of these factories are damaged, some of those claims would be reimbursed by the insurance company to an insurance company. In addition to understanding reinsurance companies, we also need to understand that an insurance contract may be either issued or held. For example, in the books of the company or factory that is insuring its own factory against damage, that particular insurance contract is held, and for the insurance company issuing that contract, in the books of that insurance company, the insurance contract is issued. So IFRS 17 is applicable only to issued insurance contracts, but in case of reinsurance contracts, IFRS 17 is applicable to both issued and held. So if we understand this chain of companies where a factory gets insured from an insurance company and an insurance company gets insured from a reinsurance company, in this case the factory would be holding an insurance contract and not a reinsurance contract, and therefore the factory would not have to be accounting as insurance contracts under IFRS 17 because it's just a contingent payment that it may receive if the factory gets burned or damaged otherwise. In the books of the insurance company, there would be both an insurance contract that has been issued and a reinsurance contract that has been held. So the issued insurance contract is against the factory's burning, and the held reinsurance contract is against is to transfer its own risk of having to pay those claims to reinsurance company. So reinsurance company would reimburse those claims or a certain amount of those claims because the insurance company has held the reinsurance contract. IFRS 17 applies to reinsurance contract held and issued, but in case of insurance contract only applies to issued insurance contracts. Now, it's very important to make this distinction that IFRS 17 does not specify that it's specifically for insurance companies. The distinction made here is on the basis of the contracts. So IFRS 17 is applicable on insurance contracts, whether or not they're issued by insurance companies or not. So, for example, if a banking company issues an insurance contract, IFRS 17 will still apply. So here is what. There might be certain companies that are regulated as insurance companies. If they are not issuing insurance contracts, they would not have to apply IFRS 17. And if there are companies that are not insurance companies, and if they are issuing insurance contracts, they will have to apply IFRS 17. Anyways, so if there is no insurance contract being issued, the company would not apply IFRS 17. If a company issues insurance contracts, that company would apply IFRS 17. However, we need to understand that IFRS 17 is not applicable on all insurance contracts. How come? There are certain contracts that are covered in the definition of the insurance contracts. However, they have been specifically scoped out. So specifically removed from the scope of IFRS 17 because they would have caused complications for other companies. We'll go into this later. Similarly, there are contracts that are not insurance contract, but they are within the scope of IFRS 17. Namely, these are the discretionary participation features contracts that have been issued by insurance company. If contracts with discretionary participant features have not been issued by insurance company and have been issued by other company, they are not within the scope of IFRS 17. But if they have been issued by insurance companies, they are within the scope. We'll talk more about what discretionary participation features are, what these contracts are, and in what circumstances these are issued by insurance companies. So here's a small summary of how IFRS 17 applies its scope requirements. So first of all, let's talk about, as we've already talked about, the contract that does not meet the definition of insurance contract, but is included within the scope of IFRS 17. And it's basically investment contract issued with discretionary participation features. It doesn't meet the definition, but it's accounted under IFRS 17 if it has been issued by an entity that also issues insurance contracts. So it's important to remember that these contracts are not insurance contracts, but they are within the scope of IFRS 17 if issued by an entity that also issues insurance contracts. Now, there are some contracts that may meet the definition of insurance contract, but are excluded from IFRS 17 unconditionally. For example, warranties provided by a dealer or a retailer. So any warranties provided is really a transfer of risk from the customer to the manufacturer or retailer or the dealer to compensate him for any damage that he might suffer because of that particular purchase. However, these warranties are covered under IFRS 17 and have been specifically excluded from the scope of IFRS 17. Similarly, residual value guarantees provided by a manufacturer or dealer or retailer and a lessee's residual value guarantee when they are embedded in a lease. So these are covered under IFRS 15 and IFRS 16 and therefore excluded specifically from IFRS 17. Similarly, employees benefit plans are also excluded, and similarly contingent consideration payable or receivable in a business combination. All of these contingent payments that may have to be paid and that may meet the definition of our insurance contracts have been specifically excluded by IFRS 17 from its scope. Now, there are some gray areas. There are some contracts that may meet the definition of insurance contracts, but still may be included or excluded from IFRS 17. We're not going to go into detail of when they might or might not be excluded. We will discuss about these later when we were talking about a little bit in the context of IFRS 9 and a little bit more about fixed fee contracts when we would be talking about IFRS 15. Right now, just remember that there are credit card contracts with some insurance components, and in some cases, it is excluded from the scope of IFRS 17. Similarly, financial guarantee contracts, which are a guarantee against suffering against non-payment by a particular person against whom the guarantee has been made. However, they are normally included within the scope of IFRS 9 and scoped out of IFRS 17. But there are cases where they may be within the scope of IFRS 17. We'll talk about that later. Finally, there are fixed fee service contracts, which may meet the definition of IFRS 17 insurance contract, but may still be accounted under IFRS 15. To sum it up, let's talk about the final conclusion that we have. So generally, IFRS 17 applies to insurance or reinsurance contracts that a company issues. It also applies to reinsurance contracts that the company holds. Also, the IFRS 17 applies to investment contracts with discretionary participant features that it issues, provided the entity also issues insurance contract. Remember that discretionary contract with discretionary participant features are not within the definition of an insurance contract. And also remember that insurance contract held by the issuer are outside the scope of IFRS 17. So any normal random company that holds an insurance policy does not have to account for its insurance policy against IFRS 17. It's only for insurance contracts issued, reinsurance contracts held and issued. Okay, now that we know the kind of contracts we are talking about, let's try to talk about the expected cash flows from these contracts. What are we expecting these contracts to realize over their terms? So first of all, we already discussed that insurance liabilities are outside the scope of IAS 37 because these are not just contingencies, because the nature of insurance business is such that we are expecting a lot of insurance contracts to have claims and we have to pay those claims, so those claims are expected cash outflows. Despite these uncertainties, insurance risk is recognized as a liability and not as a contingency. So we have to understand why is that the case. So the nature of business is such that we are pooling risk from a lot of insurance policies, and we have some calculations that actuaries make to estimate the amount of claim that the insurance company will have to pay over the contracts, over the life of the contract, and what the profitability would be as a result. So naturally, when issuing insurance contracts as a whole, in collection, insurance companies are not expecting to accrue losses on all the insurance contracts. Otherwise, it doesn't make sense to be in that business. And they are expecting profits, and they're expecting it based on historical claims data, based on other macroeconomic or outside information that's relevant in computation of expected claims from their contracts. So let's start by understanding a cash flow that arises in a typical insurance contract. Here we have a very simple example. Let's say we have 100 term life insurance contracts today, and the term is 3 years. For each of these contracts, we are about to receive a premium of $10 at the start of each of the 3 years. So we will receive 10 into 100, which is $1,000 at the start of year 1, $1,000 at the start of year 2, and $1,000 at the start of year 3. The first payment would be received at the start of year 1, which might be the first day, which might be tomorrow. The second payment would be received at the start of year 2, which is 1 year from now. And the third payment would be received at the start of year 3, which is 2 years from now. Now when we talk about the expected cash outflows, first of all, what are we expecting? We are expecting, first of all, to pay some claims from these insurance policies. And we are also expecting to incur administrative expenses on managing those policies. So when actuaries are expecting these cash flows, they are not just expecting the claims payment, they are also expecting administrative expenses. They are also expecting the cash inflow that we just discussed from the premiums that would be received. Before we go further, let's also talk about the uncertainty. We cannot just imagine a particular scenario and say that particular scenario would be 100% probable based on what we are expecting. And so we have to expect a range of scenarios, and according to IFRS 17, we have to expect a full range of scenario so that we take account every possibility. Coming back to our example, what kind of cash outflows would be expected from these 100 insurance contracts? So the term life insurance obliges us to compensation payments of $1,000 to the beneficiaries of the policyholders in case of the policyholder's death within the contract period of 3 years. So based on our actuaries' expectations, we are expecting one policyholder to die in year 2 and one additional policyholder to die at the end of year 3, and therefore the expected cash outflows would be as follows. So we have a $1,000 payment at the end of year 2 and a $1,000 payment at the end of year 3. But we also have some additional expenses. These expenses are policy management expenses. So in year 1, we are expecting a cash outflow of, let's say, $50. In year 2, we are expecting a cash outflow of $1,050. And year 3, we are expecting a cash outflow of $1,050 again. So here is a full picture of our expected cash flows over the contract boundary. Now IFRS 17 specifically defines what a contract boundary is, and which we'll learn very soon in our course. For now, let's understand that contract boundary is really the period within which all the cash flows are included in our expectations of cash flows and form part of the valuation of the fulfillment cash flows and the liability for remaining coverage. So based on our working, we said that we have the present value of cash inflows at $2,859, and our present value of cash outflows is $1,907. What does all this mean? We have issued contract today, 100 contracts today. We know, or we are expecting them to result in $2,859 in cash in the future, and we also have to pay $1,907 in liabilities. Does it mean that we have this amount as asset, or are these some sort of receivables, or does it mean that this $1,907 is our payable? And what does the difference denote? So if A represents the present value of expected cash inflows and B represents the present value of expected cash outflows, 952 is the difference, right? Is this our profit? As a matter of fact, this is our expected profit, assuming there is no risk adjustment. And under IFRS 17, we have 3 components. We have these present value of expected cash flows, we have risk adjustment, and the remaining is the profit. So if we were to account for these contracts and the general measurement model, this difference of 952 would be broken up into risk adjustment and the CSM. Assuming the risk adjustment is $52, the CSM on initial recognition would be $900. We'll talk more about CSM and why and how we calculate it. In our full course, we'll understand how we would account for these contracts, how we would initially recognize insurance contracts based on their expected cash flows, how we would subsequently measure them and recognize them in our income statement and balance sheet, and how onerous contract would be accounted for. In addition, we would also go in detail into the modifications of the general measurement model, including the variable fee approach and the premium allocation approach. I hope this was helpful. If you want to learn more about IFRS 17, don't forget to check out my full course on IFRS 17, which is available on ifrsmasterclass.com. Thank you.